Hello everyone, welcome to Option Gig. This is your host Vivek Somani. I am an option trader by passion and a full-time software executive by profession. If you want to learn how to generate consistent monthly income trading options while working full-time in your day job, then join me in this journey. In this presentation, I'll cover the very basic question that I get asked many times, mostly by the newbie option traders is, why even trade options? Why even bother about it? So let's see various reasons on why we should trade options. Since this question comes mostly from stock traders, I will try to address it from the viewpoint of stock versus options. Okay, so let's dive right into it. To understand the difference, I will look at the differences in three categories. And in my opinion, those are the three biggest differences. One is choices, number two is the amount of leverage, and the third is margin for error or room for error. Now we look into how each stock and options differ in these three categories. First, choices. In stock, you have only two choices. Or rather, I would say you have only one choice when you're actually executing a trade. You can either be bullish on a stock or you are bearish on a stock. And those are the only two ways you can make money. So you have to take a firm stance on the stock price, and your profit or loss is determined based on that particular stock price. If you are bullish, you buy the stock at the current price. And that is what 99% of retail traders do. They go ahead and buy the stock today in hope that it will rise because they are bullish on it. And then later they will sell it to make money. But if someone is bearish, then you can short sell the stock at the current price so that if stock falls down, you make money. Most of the retail traders, they don't do it. Institutional traders, yes, they do it. All right, so let's look at what happens when you buy a stock. So this is your profit and loss diagram of when you're buying a stock. Example I've taken here is that you have bought Apple at $174.52. So as you can notice, this is your profitable zone, green area on the right side. So as Apple start to rise beyond $174.52, your profit starts to increase. But if Apple stock starts to go low, your profits, you start to incur losses. I'm assuming that this is the only stock in your portfolio. So this was a profit and loss diagram for a bullish case. Now let's look at what happens if you are bearish and if you short sell the stock. So this is what happens if you are bearish. You sold the stock, you short sold the stock at $174.52. Since you were bearish and if the stock goes down, your portfolio starts to make profits. Green zone. But what happens if stock doesn't go in the direction you wanted it to go and instead starts increasing, your portfolio start to make losses. Red zone. Okay, so these are the only two options. So in this case, you have taken a firm stance on $174.52. Your profit and loss is determined how the stock move around this particular stock price. Let's look at options. In options, literally we have more options. That's why it's called options. So you could be bullish, bearish, neutral, slightly bearish, slightly bullish, or any combination of these. Hmm, that sounds interesting. Yeah, definitely it is, and we'll see more examples of it. You do not have to take a firm stance. You do not have to put a line in a sand and say, that's it. This is the stock price, and I am, and which will determine my profit and loss. You can actually go ahead and define a price range because I can't predict future. So I'm not really sure whether Apple will be staying above this price or will go below this price. But I might be able to make a judicious call on it might stay within the price range. And that is something that you can define in options. All right, so let's take an example of each one of these. This is an example of bullish. If I'm bullish, I bought a call option contract at a strike price of $175. So if the Apple rises, I start to make money. But if Apple goes low, this is my loss zone. So you make money if a stock rise. If you're a bearish, you can do an option contract to buy a put contract at $175 strike price. So if Apple falls, you make money. But if you're slightly bullish, you know that Apple will rise, but you have an idea that it may not got beyond, let's say, $195. So in that case, you can buy a call at 175 and sell a call at 195. So you make money, but your profit is capped at $195 because you're slightly bullish. Or let's say if you do not have any particular stance on Apple stock, you could go neutral. In this case, this is an example of a neutral trade in which you'll make money as long as Apple stays between 150 and 200. So right now Apple is trading close to $175. You have given yourself margin of $25 on the lower side, $25 on the upper side for next 3 months. As long as Apple stays within this zone, you're going to make money. So if you notice that how options provide us literally options to create different type of trades based on our thinking about the how the stock price is going to behave. Now let's look at the second part, which is leverage and how options provide us with the leverage. So options are leveraged instruments. One contract of option will control 100 shares of underlying stock. So in the examples that we had seen, if you had bought or sold one option contract, the impact on the option contract would be as if you're buying or selling 100 shares of Apple. So, but mind you, the leverage can cut both ways. So you have to use judiciously. And when used judiciously, your gains will be amplified if you are using options instead of stock. Okay, let's take an example of this. This was our case of a bullish, and you bought Apple at 174.52. Apple is now at 195, let's say in 3 months. And right now I'm looking at that you had bought a stock. So when you bought a stock at, let's say, 175, just to come to a round numbers, so your investment was close to $17,500. Now the stock is at 195, so your profit is $20 per single share. So you got into 100, you got $2,000 profit. You invested 17,500 because you're buying the shares. This is not an option contract. This is a long stock, means you bought the share. So you got $17,500 invested. Your realized money is $19,500. So your profit is $2,000. Your ROI is 2,000 divided by 17,500, which is 11%. Not bad. 11% for 3 months is good if Apple moves from 175 to 195 in 3 months. Well, let's take an example of what happens in case of the put contract. So I was bullish. I sold a put contract of Apple at strike price 175. Same scenario, Apple is now at $195. So when I sold this put contract, I received a premium of $8.40, and my buying power reduction, that is the amount of money which your broker will hold for you to enable this trade, was $3,500. So which is kind of my investment to get into this trade. So your investment is $3,500. Eventual profit is $840 because the stock is at 195. You'll make $840, and your ROI in this case is 24%. Much better than using just the stocks. Okay, second example we look for leverage in option trading is the call option. The previous one was for put option. This one is for call option. Again, in this case, you make money if the Apple goes up. Same scenario. In 3 months, Apple is at $195. In this case, your initial investment was close to $800, and your profit is $1,200, which is your ROI is close to 150%. Now it's a different matter in terms of whether the put is better, the previous one, or whether this call is better. That is determined by probabilities and the volatility outside of scope of this presentation, but I do have another webinars where I've explained that. Net, I think between the stock and the options, when you're comparing, options provide much better return on investment as compared to stock. Stock is not capital efficient. All right, let's look at the third thing, which is room for error. So stocks have no margin for error. If you bought a stock at $175 and if you are wrong, even by a penny, if this Apple stock goes a penny down, your portfolio goes by a penny down. If Apple stock is down by $1, your portfolio is down by $1. There's absolutely no margin for any error. Look at this example. You bought it at here. The moment stock starts to go down, your portfolio is losing money. No room for any error. Options. This was the option of selling a put contract. You sold an option at 175 thinking that the stock will go higher, but stock doesn't behave the way you want it to. Stock actually went lower than 175. But see, your portfolio has a lot of margin for error because you only start to make loss if stock falls below $166.60. So you have a huge margin for error, which is $8.40. This is your safety margin. In stock case, there was no margin at all. In options, you have a $8.40 of margin of error, which is almost equivalent to 5%. So you could be wrong in your analysis of the stock. Even if the stock falls by 5%, still your portfolio is not impacted. That's the beauty. You don't have to be right always. You could still be wrong while trading option and still make money. That's not a case when you're trading just stocks. Let's summarize everything. Takeaways: stocks are unidirectional. You can either make bullish trade or bearish trade. Options, you can have a multi-directional trade, or in some cases, you can do neutral trades. I generally do a neutral trades. I don't know where market's gonna go, so I most of the time I play neutral trades. Stocks are capital intensive. They consume a lot of capital, and hence your return on investment is muted because of the huge capital requirement. Options are capital friendly because they are leverage instruments. But please remember, leverage can cut both ways, so you have to be careful. But if carefully used, this leverage can enhance your return on investment multifold. Lastly, we saw that stocks are non forgiving. If your analysis is wrong, you are penalized immediately. Options, on the other hand, provides you a room for error. Even if you are wrong, but only by a certain amount, you still have a cushion for that amount, and your portfolio will still be healthy, even if your own analysis turned out to be wrong. So I think these are the biggest differences, in my opinion, and that's what geared me to start trading in options. I hope you find this very useful. In case if you have any questions, you can write it in the comments and below, or you can email it to optiongig@gmail.com and I'll be happy to answer any of those questions. If you like what you learned, please subscribe to this YouTube channel and help me spread word so others can also benefit from it. Thank you very much.